RBI guidelines warrant payments banks and small finance banks to maintain a capital adequacy ratio (CAR) of 15%. What is capital adequacy ratio? What are payments banks and small finance banks? Why does RBI want the new banks, particularly payments banks which will have no exposure to loans, to maintain such a high CAR? Why do payments banks have to maintain such a high CAR? GS Paper 3, Indian Economy. What is the context about? Both payments banks and small finance banks, two new beasts on India's banking turf, will be required to maintain a capital adequacy ratio (CAR) of 15%, that is with Tier 1 consisting of equity and reserves, and Tier 2, long-term debt, among other things, ratios equally split at 7.5% each. This is far higher than the CAR of the so-called universal banks, which can dabble in many banking activities. What is capital adequacy ratio? Capital adequacy ratio, CAR, is the ratio of a bank's capital in relation to its risk-weighted assets and current liabilities. It is decided by central banks and bank regulators to prevent commercial banks from taking excess leverage and becoming insolvent in the process. Also known as capital to risk-weighted assets ratio, CRAR, it is used to protect depositors and promote the stability and efficiency of financial systems around the world. Two types of capital are measured: Tier 1 capital, which can absorb losses without a bank being required to cease trading, and Tier 2 capital, which can absorb losses in the event of a winding up and so provides a lesser degree of protection to depositors. What are payments banks and small finance banks? Small banks. The purpose of the small banks will be to provide a whole suite of basic banking products such as deposits and supply of credit, but in a limited area of operation. The objective for these small banks is to increase financial inclusion by provision of savings vehicles to underserved and unserved sections of the population, supply of credit to small farmers, micro and small industries, and other unorganized sector entities through high-technology low-cost operations. The area of operations would normally be restricted to contiguous districts in a homogeneous cluster of states of union territories so that the small bank has a local feel and culture. However, if necessary, it would be allowed to expand its area of operations beyond contiguous districts in one or more states with reasonable geographical proximity. Payment banks. Objective of payments banks is to increase financial inclusion by providing small savings accounts, payment, remittance services to migrant labor, low-income households, small businesses, other unorganized sector entities and other users by enabling high-volume low-value transactions in deposits and payments, remittance services in a secured technology-driven environment. Those who can promote payments banks can be a non-bank PPIs, NBFCs, corporates, mobile telephone companies, supermarket chains, real sector cooperatives companies and public sector entities. Even banks can take equity in payments banks. Payments banks can accept demand deposits, only current account and savings accounts. They would initially be restricted to holding a maximum balance of Rs 1 lakh per customer. Based on performance, the RBI could enhance this limit. The banks can offer payments and remittance services, issuance of prepaid payment instruments, internet banking, functioning as business correspondent for other banks. Payments banks cannot set up subsidiaries to undertake NBFC. As in the case of small banks, other financial and non-financial services activities of the promoters should be ring-fenced. The payments banks would be required to use the word payments in its name to differentiate it from other banks. No credit lending is allowed for payments banks. The float funds can be parked only in less than 1 year G-Secs. Why does RBI want the new banks, particularly payments banks which will have no exposure to loans, to maintain such a high CAR? The measure is meant to protect depositors in case a bank goes bust and maintain stability in the financial system. CAR gives banks a cushion to absorb a reasonable amount of losses if too many loans go bad. It also discourages banks from making excessively risky loans and investments. They can't give loans, except to their own employees. 75% of their deposits are to be invested in risk-free government securities. They can open only savings and current accounts, and that too up to Rs 1 lakh, an amount which is protected by an insurance cover in case a bank goes belly up. So why do payments banks have to maintain such a high CAR? The payments banks will have to spend tons of money to create the right infrastructure to be in the business. The RBI is apprehensive that the payments banks will end up burning too much capital in building their franchises. More than the protection of the depositors, anyway they have insurance cover, the regulator is concerned about the future of the payments banks themselves.